Good morning, everybody. I'm David Wessel, Director of the Hutchins Center. I want to thank you all for coming out on this rainy day, but at least it's cooled off some. We had a really terrific day yesterday, and we're looking forward to a good day today. We have two papers. Everything today will be in this room. We have two paper sessions, and then we have a panel at about 12:20 on looking at the long-lasting effects of COVID on the downtowns and the municipal finance. I want to renew my welcome on behalf of my colleagues at WashU Olin Business School, the Brandeis Rosenberg Institute of something or other, and the Brandeis International Business School, Rosenberg Institute of Global Finance. We had to make the type small to fit all that in. And the Harris School of Public Policy at the University of Chicago. And I also want to renew my thanks to Hao-En Chen, Megan Waring, Stephanie Sensula, Bree Nicker, and the others on our staff who've helped pull this off with such skill and efficiency. Our moderator for the first session this morning is Steve Winterstein. Alpha Ledger, is that the name of your new firm? No. That's your old firm. So what new firm is Stephen Winterstein LLC or something?
SPW.
SPW. All right, Steve Winterstein.
Thank you. Thank you, David. I had to lower the mic here. So today, if we have Stefan Gessler presenting a paper called, and I was, you get these papers and there's, the titles can be bland sometime, even though the content is very interesting. But Pushing Bonds Over the Edge, it sounds like a terrifying title, but Pushing Bonds Over the Edge, Investor Demand and Municipal Bond Liquidity. John Bagley at the MSRB, Stefan Gissler at the Federal Reserve, and Kent Haichu at E&Y. And so I'm going to ask, and Ivan Ivanov at the Federal Reserve of Chicago. So we're going to invite Stefan up and present the paper, and Kevin Bain will be the discussant afterwards. The floor is yours. Thank you.
All right. Thank you very much for having us. So the usual disclaimer applies. These are my views, not of the Federal Reserve. And let me actually start off with something that happened way after we started this project, which was the banking stress last March. And in the aftermath of SVB's failure, BlackRock was supposed to sell SVB's large muni bond portfolio. And this wasn't seen to be an easy feast. And the bond buyer, for example, states that those bonds are very difficult to sell because the holdings consist of structure, not credit risk, which likely will require deep concessions given liquidity and the US de minimis risk. So that quote actually summarizes our paper pretty well. What we do is we document that the de minimis risk leads to illiquidity, and then we actually show how this happens. We show that it's mainly institutional investors selling the bonds. But let me not do the bond buyer the job of describing our paper and give you a better high-level summary of it. So what's the institutional setting here? Well, interest income on municipal bonds is tax exempt. However, gains from trading are not. So each bond has a threshold, and if you buy a bond on the secondary market below that threshold and either hold it to maturity or sell it afterwards, you incur ordinary income and you have to pay ordinary income taxes. Now, why is this a risk? Well, municipal bond investors are highly tax sensitive. So on the one side, we have retail investors that are often in the highest income tax brackets. On the other side, the largest institutional investors, which are muni mutual funds, often cannot incur tax liabilities. So given that background, we take trading data and basically look around the de minimis threshold, how several trading statistics evolve. We then supplement the data with quarterly institutional holdings to see how the largest institutional investors behave. And those are mutual funds, closed-end funds, property and casualty insurers, life insurers, and the largest commercial banks. And the main findings that we're going to have are that trading really plummets once bonds cross the de minimis threshold. Trading volume and trade size drop very closely to the threshold, and all this behavior is not the same across all bonds. It mainly depends on a bond's interest sensitivity. There's a lot more trading still going on close to the threshold if a bond is less interest sensitive. If a bond is highly interest sensitive, the sell-off occurs way earlier. Now, what's driving all this? Well, it's mainly the institutional investors selling their entire positions. I'm going to show you that once a bond moves towards the de minimis threshold, the largest holders, which are mutual funds, sell their entire positions and move out of the market. Their behavior also depends on the interest sensitivity of the bonds. They wait a little bit longer if a bond is less interest sensitive. While this is all in the cross-section, in one of the last exercises, we'll then look at the time series dimension of the risk and show you that it's not stable over time. Monetary policy, especially contractionary policy, actually amplifies de minimis risk over the cycle. So in the remainder of the presentation, I'll just go into more detail of these points. But before this, let me give you either a reminder or a little primer on what the de minimis threshold actually is. So obviously, from tax-exempt bond, interest income is tax-exempt. But the IRS says, well, if you get gains from trading municipal bonds, you have ordinary income and you have to pay taxes on that. So they set a threshold, which is a so-called de minimis threshold, and say, if you buy a bond below that, you will have to pay taxes once you realize the gains. They can either be realized once you sell them in the secondary market again at a higher price, or if you hold the bonds until maturity. The general formula the IRS sets is basically the so-called adjusted offering price minus 25 basis points for each year of remaining maturity. So the adjusted offering price is very simple to calculate if a bond was issued at par. It is simply the par price. So for example, if you have a bond that was issued at par and has 5 years of remaining maturity, the de minimis threshold is just 98.75. If you have an original issue discount bond, it's a little bit more complicated, but more or less it's the same style and feature, right? So what we do is we calculate for each bond that was traded between 2010 and 2022, for each bond in each year, the de minimis threshold. Then we take, as everyone else in this room, mainly for the presentation, the MSRB data. We aggregate it to the weekly level. We calculate average weekly trade prices. And then we supplement this data with quarterly institutional holdings data coming from EMAX. They have data on mutual funds, property and casualty insurer, life insurer, and closed-end funds. And now we also use confidential supervisory data from the Federal Reserve's Y14 that covers all the commercial bank muni holdings above $100 billion. So with this, we basically then just look at several trade statistics around the de minimis threshold. And the first piece of evidence that the de minimis threshold actually leads to illiquidity can be seen by simply looking at a histogram of our data. So what you see here is the frequency we have of trade prices in our sample along the distance to the de minimis threshold. So on the x-axis, you basically see the average trade price minus the de minimis threshold. Positive numbers means that the bond was traded above the threshold, and negative numbers mean that the bond was traded below the threshold. And what you see is that once you approach the de minimis threshold, first trading frequency increases and then pretty quickly drops off and never recovers. Now, how quick that drop-off is and when the trading frequency really disappears depends on the interest sensitivity of a bond. So what I don't show here, but what we do in the paper is we divide the sample of bonds with a duration above and below the median. And for high duration bonds, the sell-off or the trading frequency actually resembles that picture. And for bonds with a low duration, you have a lot more trading still going on between 1% and 2% above the de minimis threshold. Now, looking at other trading statistics, we also see quite a big deterioration approaching the de minimis threshold. This slide shows you on the left the traded volume of a bond during a week, and on the right, the average trade size of a bond during the week. And you see that both of those variables decline pretty rapidly once you move to the de minimis threshold. Now, one caveat to have in mind when looking at these charts is they are conditional on a bond actually being traded. So while it may look like that these statistics recover once you cross the threshold, bear in mind that I just showed you that there are barely any trades to begin with. However, the trades that there are really expensive, as you can see here. So what we do here is we calculate for each transaction the markups, meaning that we construct complete intermediation chains and then just take the difference between the last sale from a dealer to a customer and the very first sale in the chain from a customer to a dealer. And what you see is that irrespective of the trade size, trading costs actually increase threefold for every trader once a bond has crossed the de minimis threshold. Now, what is going on here? Well, the first suspect to look to are mutual funds. They are the largest holder of a municipal bond and one of the largest participants in the secondary market. And as a whole, they are actually very large net sellers of muni bonds once they approach the threshold. What you see in this graph is just simply net buying of the muni mutual fund industry, again, across different buckets with the distance to the minimum threshold. And you see that this picture basically resembles the trading frequency graph I showed you earlier on. So once you move toward the threshold, the mutual fund industry starts selling their entire positions. They don't sell gradually. If a mutual fund sells, they sell their entire position. Again, for them, the timing of the sale depends on the interest sensitivity of a bond. If we take bonds with a low duration, the selling is way closer to the minimum threshold. Now, what does this, and we don't show it here, but for most of the other institutional investors, the picture actually looks exactly the same. I could show you the picture for commercial banks. It looks like this. Property casualty insurers, it looks like this. Closed-end funds, it looks like this. The only investors we don't see this behavior are life insurance companies, which we usually think of as our very typical buy and hold investor. Now, all this selling by institutional investors actually has a large effect as well on retail investors. What we show in this table is we run our measure of markups, so trading costs, on a dummy that is 1 if the institutional investors have sold the majority of their position in the previous quarter and then interacted with the distance to the de minimis threshold. And what you see is that once a bond crosses the threshold, trading costs not only increase unconditionally, as I showed you before, but for small and medium trades, there's an additional increase in trading costs of about 10 to 17 basis points. So selling by institutional investors has a large externality for retail investors and medium trades. In another exercise, we're addressing a 2010 paper by Ang that basically made the claim of, in order to explain the large increase in yield that you observe once a bond crosses the threshold, you would need an implicit tax rate of about 100%. What we do here is that we show that it's most likely illiquidity driving this. In order to make that claim, we divide the sample in turnover and then basically take a dummy if a bond was in the lowest quartile of turnover and again interacted with our distance to the minimum threshold. And what you see is that the effect is by far largest for the most illiquid bonds. And we therefore think it's less likely that it's 100% implicit tax rate, and most likely the expected illiquidity of the institution of those municipal bonds that drives institutional investors to sell those bonds in order not to incur those high trading costs and in order not to be forced to sell those bonds in the market when it's very, very illiquid. Now, while these are all things in the cross-section, let me spend the last exercise on the time series dimension of the de minimis risk. Obviously, as monetary policy increases rates, bond prices go down. And what you see in this graph is a time series of bonds traded in the region where they are basically at the risk of the sell-off. So between the de minimis threshold and 4 percentage points above. This is even a very tight spread, as you've seen. If we would increase this by 1 or 2 more basis points to 5 and 6, we would still call them those are bonds at risk. And even though it's not graphed here, you may be able to see that it really resembles the path of interest rates over time. And in times of contractionary monetary policy, as we are in right now, sometimes over 30% of bonds traded in a given week are actually bonds very close to the de minimis threshold. So I hope I convinced you that the de minimis threshold actually leads to illiquidity in the secondary bond market, and that the mechanism behind this is institutional investors expecting illiquidity, expecting a large increase in trading costs, and therefore moving out of the market. Now let me close with one thing that I haven't answered so far. Who is actually buying that stuff? And I showed you data on all the institutional investors that we can observe. So this is a very large caveat, and it seems that anecdotal evidence points toward either small banks buying those things or hedge funds buying those. Going back to the example I mentioned before with BlackRock selling SVB's bond portfolio, apparently the sale went pretty smooth. And anecdotally, it seems it was institutional investors moving in and buying those bonds. The problem here is we don't have data to observe hedge funds. On this rather not so good note, thank you very much.
Thank you, Stefan. And Kevin Bain, hi Kevin, is going to address the paper and give us his thoughts. Thanks, Kevin. City of Detroit, by the way. Thank you, Stephen.
All right, well, good morning, everyone, and thank you, Stefan, for the wonderful presentation, to all the authors for a great paper. My name's Kevin Bain. I'm the debt manager for the City of Detroit, and obviously these are my own thoughts, not the city's. So I actually started my career in debt capital markets at Citigroup, issuing bonds for corporates, which were taxable bonds, of course, and then I joined the city 2.5 years ago, where I started issuing tax-exempt bonds. And immediately I had these questions about why the tax-exempt bond markets were peculiar and different than the taxable markets. And this paper actually answers a lot of my questions. Also begs more questions. And so that's what I'm going to talk about today. To summarize some of the key findings that resonated with me the most, not necessarily the author's major findings, but for me, is one, the impact on liquidity, and two, the steep sell-off in these bonds as they approach the de minimis price. Not at the de minimis price, but as it gets even just relatively close. Third, this acceptability to economic and monetary policy decisions, which is what Stefan was leaving off on. Here, the red line is actually the Fed funds rate, so you can see the stark sell-off of bonds. And then last, what is the purpose of this rule and why that is causing this distortion? So the paper does address it a little bit. It says that the rules passed in 1993, so it's the same. Me and it are the same age. I'm a couple months older, so I'm a little bit wiser. But the goal was not really, it was not part of the major goal. And the estimates, it's not even one of the estimates in the Congressional Budget Office's estimates. So although a lot of people here probably know how bonds price, just a quick run through for the taxable bond markets. Issuers set the par value that they're going to sell. They build the order book with investors. If there's a lot of a demand, we can drive down the interest rates and lower our borrowing cost. And then ultimately we set the yield and the coupon set at that yield. So the characteristics of a taxable bond is that the issuer sets the par value and that determines the issuance size. The market determines the yield, which sets the coupon. The tax-exempt bond market operates differently, though. For us, we actually set the coupons ahead of time. The market standard is that we use 5% coupons. There are sometimes lower coupons based on your rating or the interest rate environment. But the 5% coupons are the standard. I've asked many times why this is, and usually my answer is it's just market standard. I think there are probably a lot of factors, but this discount rule has to be one of them. And I know that because when I do sell bonds and I go to investors, we have to set that 5% coupon, which is much higher than yield, in order to offer investors protection that these bonds will never fall into the discount territory where they become highly illiquid. So the results are that the coupons don't equal our bond yields, which means that the issuance size does not equal par value. And to me, this is market distorting because especially when a lot of our bonds are approved by voters and voters approve the size of the bonds, we have to decide, are we setting par value or are we setting the issuance size? So the summary is that in the tax-exempt bond market in comparison to taxables, the issuer sets the par value and the coupon. The market sets the yield, which then determines the issuance size. So I joined the city right in the middle of a bond transaction in 2021. We sold $175 million of bonds, and we actually had a tax-exempt series and a taxable series, which makes for a great comparison. Our tax-exempt series had about a 3.369% yield, but our coupons were the market standard of 5%. Our long-term bonds actually were at 4% coupons because interest rates were so low due to, and then interest rate sensitivity. But anyways, we had over $30 million of bond premium, which is pretty sizable for this size deal. In comparison, our taxable bond, $40 million, yield was 3.185%, coupon set to match the yield, and that's how much we received in proceeds, less the cost of issuance. I can return to this later if there's questions, but what I'm showing here is the rows of the maturities and the coupons. You can see they're all 5 or 4%, and then the yield column showed that our yields were in the 2%, which is so far off from the coupons. And here, what to look at is the price column, because if you were pricing a bond at par, all those would be 100. But instead, we're actually pricing about 25% premiums at this bond. So to put it in context, our 2021 deal took place at really historical market lows. We had an optimal timing for this bond. We were very happy about it. As it just so happens, I also priced a bond last week. Thankfully, there was a really good inflation report, and we were able to accelerate our bond deal because I was very nervous about pricing a bond while standing up here at the same time. But now I have a great comparison to talk to you about. So as we're going into this deal, we obviously look at how our bonds are trading in the secondary market. And as it so happens, the bonds we issued in 2021, some of them are trading below the de minimis threshold at the bottom of the screen. Our 2021s that were issued at the 4% premium are now in the low 90s or high 80s and have become highly illiquid. This happened even though we offered the investors the protection of issuing the higher coupons. These were 4%, they weren't 5%. But keep in mind, the 4% coupon still generated 25% premiums for us. So if we had done the 5% coupons, we would have had really an extreme premium. So going into this deal, again, we actually had 3 series, 2 tax-exempt and 1 taxable. The first tax-exempt series of the $52.5 million was a little bit on the front end of the curve, so the yield was actually below 5%. But what's interesting is that even though it's below 5%, that wasn't enough for investors to accept the 5% standard coupon, and we actually had to increase our coupon to 5.25% or 6% in some cases. And what's interesting to me about that is that, again, even though we could get below 5% yield, we actually, based on our underwriters' feedback, didn't think we could sell those bonds because it would be just too close to par and too risky going into discount territory. The $25 million deal was more on the long end of the curve, so priced at 5.3% yield, and we had to do 6% coupons. Both of those priced with just a little bit of premium this time. But again, the taxable bond, very simple. Yield was 7.4%, set the coupon to match the yield. We received the $22.3 million after cost of issuance. So here you can see for this most recent tax-exempt series last week, is that our price is much closer to par. We have about, on average, a 6% premium. But my experience with this is, as I try to explain this, because I do have to explain everything that happens to public commenters and to city council. And so the question is, if the market widened 200, 300 basis points in this 2 years, why did our coupons only change 25 basis points or 100 basis points in some cases? That may sound like a win, but one day the rates will come down and they're going to ask us, why didn't our coupons come down more? Also very interesting to me, again, that even though our yield was under 5%, we still couldn't do that 5% coupon, and we had to increase our coupon. So it seems bizarre to me that coupons actually change the yield. You really, in a normal world, you wouldn't think that the coupon actually changes your yield, although it would obviously change your issuance size. But if we wanted to keep that 5% coupon, we would have had a higher yield and probably not been able to sell those bonds. And then secondly, I thought what was interesting is that in this high rate environment, due to monetary decisions, although our coupons didn't change much, the amount that we issued, our issuance size and our premium, did change a lot. And again, this gets confusing when we're trying to meet voter authorizations and we have to figure out, Are we going to set par, or are we going to set issuance? And that can get very confusing on one pricing day when you're trying, if you do decide to set at an issuance level, you have to actually decrease your par during the deal. So all in all, I just keep wondering, why do we even have this market complexity? And so my takeaways from, again, I thought the authors did a really great job, and I don't have a lot of feedback on how to improve their current scope because I think that they really explored all the angles and had robust methods. But and just can't help correlating this to the primary market. So in the author's findings in the secondary market, we find that investor demand really decreases a lot, not at the price, the de minimis price, but before it. While in the primary market, we actually have to set our coupons well above the yield to do a bond at premium. So investors are asking for this protection the entire lifetime of the bond at issuance and during secondary market trading, and really creating a level of liquidity. So two, the bonds are highly illiquid below that de minimis price in the secondary market. In the primary market, the bond yields are driving the coupons higher. So I can't even sell a bond with a coupon too close to my yield. It makes selling more difficult. And then lastly, the effect of monetary actions on both the secondary market and the primary market. And so my feedback is that I would love to see this research expanded into the primary market. I would particularly like to see how issuers deal with the issuance premiums in different ways. I think it might be interesting to compare how different coupon bonds trade. Again, in a normal world, you wouldn't really expect the coupon to affect trading. But we do see, since it does affect it in the primary market, maybe it does have an impact in the secondary market as well. And so I'd really like to question who benefits from this rule that's causing such market distortion. Because I would like to answer that if this rule does cause market distortion, then who's getting the benefit and what's the point of it? So again, thank you to the authors. I really enjoyed reading the paper. And as Stephen said, great title.
Stefan? So, Stefan, why don't you respond to Kevin's comments for a few minutes, and then we'll open it up to the audience.
All right. Well,
Here.
okay. Perfect. Well, first of all, thank you very much. I think you filled a gap that is always asked of us, always when we present it. And there are a lot of economists that think like, oh, liquidity in the secondary market, who cares? So for people who don't intrinsically care about liquidity in the secondary market, the follow-up question is always, so what happens in the primary market? And I think you filled like a massive gap in our understanding how it distorts that market, and provide a very good starting point for us to think more about it. Toward your suggestion of like more exercise, what we can do, I think it's very good the point with the coupons, looking at different coupon rates. When we started the project, we wanted to do it. Problem was interest rates were very low. So the 5% coupons, which are most of the bonds, were really far away from the de minimis threshold. Now, thankfully, the Federal Reserve have come to the rescue, and now those 5% bonds are very close to the threshold, and some of them under, so we should definitely revisit that. But again, thanks so much.
So I'm going to weigh in as a previous institutional buyer. I can say the observations are spot on in both cases, both with the paper and Kevin, your observations. I think that it would be interesting to pair this paper with Andy Calate's work on the acceleration of duration and around the market discount cutoff price, and how that duration becomes negatively convex. It accelerates to the downside. But having said that, I'll turn it over to the audience, and I have to call one of the authors, Kent Taishu.
Am I allowed to comment on my own paper?
You are.
Okay.
Can I
think
prevent
Kevin,
you?
I have an answer for Kevin. The beneficiaries are the mutual funds that are buying your bonds. because the distorting effect that's not accounted for directly in the paper is the standard 10-year par call in the market. So in effect, you want to borrow for 30 years. The mutual funds are lending you money for only 10 years because the coupon's really only locked in for 10 years at that point, or your yield's only locked in for 10 years. After 10 years, the yield kicks eventually to the coupon on the bonds. So you have a huge incentive, unless interest rates take off, of refinancing your debt at an unknown cost in 10 years. So effectively, the mutual funds have gotten a yield of 30 years, or somewhere between 10 and 30 years, because the index is all 5% coupons. So when you price to a spread, it's not the spread that's 30 years, it's the yield to worst on the 10-year. And so effectively, you're borrowing 30-year money at a price that doesn't reflect, or that reflects the likelihood that you're going to call the bonds out. And so the investors are getting a higher yield than they should. For example, there's a whole lot of reasons why muni issuers, and including Detroit, couldn't sell 10-year debt with a bullet maturity. Rating agencies don't like that. You've got rollover risk. You probably have statutory restrictions on your ability to have a big balloon payment due in 1 year. But it would be very interesting if the municipal market would start selling more 10-year bullet maturities and find out what the true 10-year cost of capital is, as opposed to selling 30-year bonds with a 10-year call that's going to force you to refinance your debt at an unknown interest rate on that date. So,
Thank you.
And my explanation of this to Ivan, I guess, is the reason why I'm listed as a co-author, because I didn't write a word of this thing. It's
Yes, Mike.
Mike Ivsick, Bancroft Capital. Appreciate the conversation. You said your dates when you were looking at the trading was between 2010 and 2022. Obviously, you've got a falling interest rate environment for pretty much the entire duration of that time period. So I'm curious, as your thoughts with the data that you looked at, what would you expect to see now that we're in a rising interest rate environment? Because obviously the de minimis, in a falling interest rate environment, the de minimis is going to be helped by the fact that bonds continue to gain in value. As it's gone the other way, you see Kevin's slide, and you see the difference in his pricing and what he was able to do in the secondary. Obviously, you're going to see those bonds sell off from premiums to $91. What do you anticipate if you were to do this in 3 to 5 years and look at the rising interest rate environment? What would you expect to see?
So the results are actually, well, as I said, before we started, we only had the decreasing rate environment. We started 2020 even, maybe, something like that. And obviously, once we started including more and more data, 2021, 2022, now even more recent quarters, the results just got stronger. So the results are perfectly robust even in a low rate environment, but as you clearly mentioned, it's there are just less bonds traded close to that threshold, and the closer the higher the interest rates move, the more mass of trading you have going on. And now, as I mentioned to Kevin, now we even see 5% coupon bonds in this region. So I think if we move 30 years down the road, I'm not sure if I'm still working on the de minimis rule in 30 years, but I still think the results will hold, and we will see the exact cyclicality that I showed in the last slide of just depending on the level or the increase in interest rate at the given time, you will see either maybe just 10% trading close to the threshold, or as we see right now, 30-40% trading close to the threshold.
I got time for one more. Matt, I think you were one of the first guys with your hand up.
Yeah, thank you so
But make
much.
it quick. We got 3 minutes.
3 minutes. All right, I'll make sure I keep it under one. So generally speaking, when pricing a new issue deal, right, this is for you, Kevin. You mentioned about institutional accounts coming in for bonds, right? And generally the oversubscriptions in these maturities is what actually drive a lower interest rate or borrowing cost to the issuer. So my question to you is, why would issuers be focused on secondary trading as opposed to the actual cost of issuing the debt?
Yeah, thank you for the question. I mean, I think I know this from when I do go out into the bond market that, investors express their concern if we're too close with the coupon of the yield that the bonds will fall into discount territory. So again, in 2021, we didn't really have these conversations. We really just went with the market standard, which was 5% coupon. So we didn't really have that experience. But in 2023, when our yields were so close to the 5% coupon, and I think a lot of people believe that interest rates are close to a peak and will be coming down soon. So they're not so worried about bonds going down too far in the future. But if it was just too close to par, then there's still the risk, especially in the short end of the curve, where it's an arbitrary rule, right? 25 basis points multiplied by years maturity. It could have been 50 basis points, 100 basis points, 10 basis points. I don't know why they chose 25. But the short end of the curve, you really don't have much room to fall into discount territory below the de minimis pricing. So I think that, of course, investors care about buying bonds that are liquid, that they believe they can trade in the future, and they don't want to buy something that is at risk of becoming illiquid anytime soon. So I do think that it carries over. I do think that, there's institutional investors in here, so you can chime in. But I think people do care about whether they'll be able to trade in the future.
Thank you. We got to keep things moving here. I've been appointed the taskmaster, and so what we're going to do is move on to our next paper. So thank you guys very much. Well, I'm going to stay up here and introduce. I've been really, it's a privilege because I have really interesting titles that I'm moderating. The Complexity Yield Puzzle, a textual analysis of municipal bond disclosures, something that we're all interested in and something that's extremely important in governing costs of borrowing. So this paper, written by authors Michael Farrell from the University of Wisconsin-Milwaukee, Dermot Murphy from the University of Illinois in Chicago, and Marcus Painter from St. Louis University, and Guangli Zhang from St. Louis University. And I believe, Marcus, you are going to be presenting, so have at it.
All right, thanks. All right, thank you. The effective transmission of information is going to be a joint activity between a sender and a receiver. And so if we think about the optimal way to have a financial market function, we need clear communication between the investors and those that are seeking the funds. So if you're going to communicate with these investors, one of our primary ways of doing that is through our disclosure. And we need to think about how to write that disclosure based on who could be the ultimate end holder of that investment. So it's still early in the morning, so I thought cartoons would be a good way to brighten up the day. So my extreme example of what our clientele in the muni market is kind of as follows. We're going to have a lot of a gradient in between who can be these, but one extreme might be a very professional institutional investor. You could think a portfolio manager at a muni bond mutual fund who has a wealth of resources to process a lot of information. They might have a team of analysts, and they themselves are going to have extensive investing experience. They want as much information about that bond as possible to process and to value that bond. The other end of the spectrum is going to be retail investors. They could be very intelligent, successful people. My example here, he works in medical equipment sales, so he's done very well for himself, so he's in a very high tax bracket, but has limited time, might have an advisor helping, but ultimately investing on the side. Going to have, especially compared to an institution, much lower bandwidth in terms of processing complex information. So if you look at a couple of different bonds, I pulled a couple from the city of Stillwater here. This is a relatively straightforward disclosure, just looking at the table of contents. You see how we might see a reaction from these investors. The institution will be happy to see what they have, but they might want even more information because they can have the bandwidth to process this. whereas our retail investor might be satisfied with that straightforward disclosure, again, because they don't have so much time for any more extra information. But if you go and look at this is another bond I pulled from Stillwater that even just from the table of contents, you can see is much more complex, about twice the size. Now the institution's happy, so much to analyze, there's a lot of information here. The retail investor might struggle here. And then again, it's not because they don't understand the information, they might not have the bandwidth or the time to go through all of this. So they might just pull back from this specific bond. Now, we think this is a real issue in the muni space because of the lack of real straightforward policies in how these things are constructed. It's kind of like the Wild West when you're in these statements. There's no standard, management disclosure section. There's no risk section like you see in the public markets. So you see very large variation here. And now the SEC has become more vocal about this and concerned about the state of disclosure in the muni space. There's been some enforcement actions against both municipal advisors and issuers. But then there's also been pushback on standardizing these things from local governments and underwriters. So we have some tension here about what's going on in this space, and I think there's going to be effects on cost of capital because we have a market that's predominantly individual investors that are ultimately owning these things. So that gets to the research questions here. We have two main research questions. First, does the complexity of these statements actually have outcomes for the market? Does it affect cost of capital? And we find that it does. So we call this our complexity yield premium. It costs more to issue, or there's a higher associated cost to issue bonds that have more complex disclosures in the primary market. Now, this is driven by bonds that are more likely to have retail investor presence, as well as bonds that have less complementary information. So if they're unrated, for instance, you're going to see a higher premium. We don't have time to look at the secondary market today. We do look at it in the paper. We see that the more complex statements are associated with more volatility and a higher markup differential between retail and institutional investors in the secondary market. The second part of the paper is just trying to look at the characteristics of these official statements over time, which is where we uncover that puzzle that's in the title of the paper. We see a stark increase in the complexity over time, which we think is puzzling because these bonds typically cost more to issue if there is much more complexity in those statements. So we delve into why. We find suggestive evidence of a clientele effect catering to institutions specifically. And then we also find some evidence that increased regulatory oversight without a really standardized policy structure is also leading to this complexity. So a little bit more about these statements. I think everyone here is pretty familiar with them. But these are kind of our end-all, be-all of what we need to look at in the primary market for bonds. So there's not a lot of guidance on exactly what needs to be in here, except for we need to be complete, which means an investor should not have to research the bonds beyond what is available in this OS. All of our material information needs to be within this. And we get a lot of the contents that you care about, the maturity of the bond, the size, whether or not it has a credit rating. So we collect these from MSRB. They're posted on Emma, but we get the bulk download of them ever since they've been required to be posted on Emma from mid-2009 through 2019. And we're going to merge this with primary market data from Mergent. We end up with about 85,000 statements, which are, of course, associated with a lot more bonds, but we'll look at this at the issuance level. So then we need to measure the actual complexity here. We can't just look at the visual table of contents. We need to do it more systematically. So we're going to rely on some motivating literature, both from finance and the linguistics space. From the finance space, we think a lot about the overall volume of information, things like the number of pages and the word count of the document. And then there are a lot of different ways of thinking about the readability of a document from the linguistics literature. And we're going to create a composite index of these. So we didn't want to take too big of a stance on any one of these. What we're going to do is kind of take all of these and say, if they're all kind of trending towards complexity, that's going to be a complex document. We'll center it around 0, so that if you have a complex index score of 0, you're an average complexity in the sample. If you're 1, you're 1 standard deviation above, and it can go above or below. Thinking about some stats here, these things are usually about a couple hundred pages. On the low end, about 80 pages. A high end could be upwards of 200. The readability scores are typically at a grade level to think about. So like on the the 25th percentile of these readability scores. You need about an undergraduate degree to understand them, roughly speaking. At the higher end, you need basically a PhD. So these things get pretty complex when you're getting towards the high end of the distribution. So I wanted to pull one excerpt just to show that it seems to be capturing complexity in a document. So this one is an official statement from the Massachusetts Health and Educational Facilities Authority. It's talking about the debt service fund, a lot about how it might be redeemed through outstanding different pieces here. I'm not going to read the whole thing. I just wanted to show this is one sentence in the document. It's the run-on to end all run-ons. You see a lot of this within these types of complex statements. And we're picking up that in our index here. This one's 1.2 standard deviations above the average here. Now we want to see if this is associated with a higher cost of capital for investors in the primary market. Does it cost more to issue these things? So we look at yield spread. We're looking at this in a relatively standard regression framework with the typical bond controls and fixed effects. We look at it in several different ways. I just wanted to show that time series graph once again about that complexity yield premium. What this is telling us is how much more does it cost to issue one of these bonds if we had a one standard deviation increase in our complexity of these statements, and I'm showing it over years. So it's pretty stable between about 4 basis points and close to 8. The full sample average is about 5 basis points. So that association, it's pretty economically significant. One way to think about this is we look at issuances with a disclosure complexity that's a half a standard deviation or more above the average. Collectively within those issuances, they pay about $1.4 billion more in issuance costs. That's over our sample here, but it's a pretty economically sizable magnitude for this complexity yield premium. So we want to look into ways of figuring out where this is the most important. A couple of hypotheses we look at is looking at where retail participation might vary. So we're looking at a clientele effect where we might have investors that might have that lower cognitive bandwidth to process these things. The other place we're going to look, and I'm just going to skip to results here, but looking at the second piece is where complementary information might be lacking. So we might not have a third-party credit source, or that third-party credit rating might not be as informative. So just skipping to the results here, we look at this complexity yield premium in interaction tests, but what I'm showing you here is the effect in settings where we have low institution versus high institution investment. So in states where we have with no tax privilege, we're going to have more institutional investors. So that's the red graph. The second one, we don't see an effect. Whereas where there is tax privilege, we'll have more retail investors. We see that complexity premium. When we look at bank-qualified bonds, we have more institutions for those. Obviously, we'll have banks investing. There's no effect. When they're not bank-qualified, it's larger. We also pulled from Stefan's paper the de minimis threshold. Those bonds that are issued at a higher price are going to attract more institutional investors. We don't see the premium there. This negotiated one's actually flipped. So negotiated bonds have a special window in the primary market for retailers to invest. So we'd expect them to actually be participating directly in the primary market here. And we see the effects higher for those negotiated bonds. When we look at credit ratings, so these are bins, high grade, medium grade, low grade bonds, and then unrated. We see most of the effect is coming from those low and unrated bonds, where again, we're going to have less complementary information so that we'll have to rely more on the context of the official statement. So the second part of the paper, we're trying to document whether or not this is changing over time, and that's, again, where this puzzle comes from. We see that complexity has been drastically increasing over time. Again, it's costly to do this, so why is this happening? Why are they getting more and more complex if it's costing these municipalities more and more to issue these things? So we look at two hypotheses to try to explain why it's increasing over time. The first one we call the catering hypothesis. This is that complexity might be increasing in subsets of bonds that cater to institutions where this premium might not really exist. We find some mixed evidence of this. It's not particularly robust across different tests, but we see some evidence of it. But I'm going to skip to the regulatory burden hypothesis, which we think is a bit more robust. The idea here is that if there's increased regulatory burden for a municipality, they might just start to throw a lot more information into these statements to try not to get sued or dinged later on for omitting something. Again, because we don't have that standardized framework, they might just try to keep compiling more and more information into these documents. So the way we look at this is by exploiting regional variation in the number of SEC enforcement officers in regional offices. So between 2015 and 2017, there was a very drastic increase in the number of SEC officers due to a push by Mary Jo White, and there was large regional variation. Overall, the number of enforcement workers increased by 70% during this period. The Boston SEC office saw an increase by 150%, Fort Worth only 9%. So we're going to do a diff and diff here. We're going to sort our munis that are associated with states that have a high enforcement increase. So the Bostons of the world, if your bond is issued in Massachusetts, you're going to have a high enforcement sorting in our test. If your bond is issued in Texas, it's going to be a low enforcement, and we'll do that for all of the regional offices of the SEC. So let me just show you that over time. Again, the outcome here is how complex are these documents, and we're comparing the difference between the high enforcement states and the low enforcement states, the bonds that are issued in those states. They're not really different before about 2015. We see very insignificant results there. Around 2016 is when we see a stark increase, and we see much more complexity in the documents of munis that are issued in those high enforcement states. And again, it was 2015 to 2017, so we saw kind of a rollout of those enforcement workers. So we kind of see it gradually happen over time. The last thing we do is try to add some structure to these unstructured documents by doing some machine learning through what's called latent Dirichlet allocation. It's a topic modeling that uses textual analysis to group words that are very similar to each other. And then we as researchers assign what these groups look like within the documents. The four groups that we identify as the most prevalent within these documents are risk sections, bond description, cash flow, and legal. What comes out from doing this algorithm will tell us certain types of words that we then group. So when we see this, the sections that are talking about things like mean, resolution, and shall, we think that's legal talk. When it's talking about default, event, trustee, we think that's risk talk. And we want to see, is the complexity within these sections more informative about the yield spread over our sample here. And we'll do this for subsets of our rating bins. So again, a lot going on here. I just really want to point out the biggest effect here. Again, these are the coefficients on the complexity within those different parts of the statement. The legal complexity is the most important. So across from the high grade bins all the way down to the unrated, legal is driving this complexity yield premium. But it gets bigger and bigger when we're in those low and unrated sections, whereas the others become most important in low grade and unrated, but their magnitudes are going to be much smaller. So in conclusion, there's a cost to complexity in the municipal bond space. We think it's largely because we have a large presence of ultimate investors being retail investors. If there's more institutions, it's not such a problem. Despite of that, kind of puzzlingly, we see a stark increase in complexity. We think it's because an increased regulatory oversight, and there's also some evidence of that catering hypothesis. Thank you very much. Wynn, I look forward to your comments.
So for those of you who've been coming to this conference for a while, you're all familiar with the inimitable Wynn Smith from Wells Fargo. Wynn, please. Thanks.
Good morning. I'm Wynn Smith. I'm with Wells Fargo in the AI innovation team, but I have 30 years of bond market experience. Before I start, I do have to stress that these are my thoughts and not those of Wells Fargo. Thanks very much for that interesting presentation, Mark. And I'm really glad these two papers came together this morning because the de minimis talk and these real examples from Detroit really set up an important issue with this kind of analysis, which is the dependent variable here is a yield spread or a complexity yield premium. And the calculation here is done comparing expected cash flows on a municipal bond to maturity to treasury cash flows or treasury bonds to maturity. So as I understand it, what we got here really is a muni bond yield to maturity versus a treasury yield to maturity. And as we just saw in the earlier presentation, the market has gotten very strange with all these high premium callable bonds. And as was mentioned, these bonds are really, in effect, 10-year bonds a lot of the time and not really 30-year bonds. So, and I've mentioned this, but I think it'd be really important for you to take a hard look at the call option and make sure that you're taking that into account and not just assuming that the cash flows and maturity are the most relevant thing here. And I think that that yield spread also was involved in a couple of the papers yesterday. So I think anyone who's doing this kind of regression analysis in the municipal bond market, you've got to be real careful. I think there's a corporate bond approach that's been adapted to municipal bonds, but that call option is so important. It's not just a flag that should go into the regression analysis. It completely changes the character of the bond. So it's really crucial to take into account the call option, and that's that may change the character of some of the results. So I hope that you do that. And then that, of course, was something that Andy Collatay talked about at length yesterday with great passion, as he always does, and it really is important. It's something that creates all these weird, distorting things in this market, and so I just urge all researchers to be very careful about that. But I do want to mention this is a really great paper. This analysis of the complexity, I like the topic analysis. And it's really very plausible that complexity makes costs higher for the retail investors, and the retail investors are really important. There's more and more of these separately managed accounts. There are a lot of fairly sophisticated retail investors, but when you have all this, often there's just redundant, difficult information. That example you had up there, I didn't do slides because I would have to go through 5 layers of approval at Wells Fargo. But if I could do a slide, if you remember the first Willy Wonka movie, and the kids come into the factory, and they have to sign this contract. Does anybody remember that contract? It starts up here, and it gets into smaller and smaller print, and just kind of goes off to infinity. And it's pretty much like a bond. And that looked just like that. And it's great, and that's what a lot of legal disclosure looks like. But you worked on complexity, you use these measures of complexity, some about readability. I just want to point out that where's Rich? There's Rich. Rich hosted a really interesting discussion at lunch yesterday about disclosure quality, and I learned a lot from all these different perspectives. And there's a lot to disclosure quality. It's a complex topic, but complexity itself is just one of the issues. So you kind of have an axis between simple and complex, but it's not the only axis. And there's an example in your paper that got a fairly good score because the sentence is well short, but it basically said this account is blah 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 blah. This other account is blah 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 blah. It was kind of a run-on paragraph. It wasn't really that easy to read, and it wasn't really that easy to say, well, why is this here and what does this matter? And if you spend enough time on it, you can say, well, these 3 accounts really actually are true assets, and these other accounts are things that the issuer manages for somebody else. but you got to spend a lot of time to break that out. Even though it's short sentences and it's not that complex in one way, it's really not very clear. So I think there's an axis between, clear and unclear, and it's not quite the same thing as between simple and complex. So, and then there's, is it standardized or not? We had a great conversation about, well, can everything get standardized, or is it practical, or how do you define what the standards are? There's so much that so much to think about with all of that. But there are some new approaches to looking at clarity with neural networks. There's a paper I'll share with you. I don't know if you can use that or not, but that would be something to take a look at. The last thing I'd really like to mention is, I guess I'll say that pirates didn't cause global warming. I don't know if you've seen this, but there's a nice chart that says that the number of pirates going down over time is correlated very well with global warming. So, yeah, these are two things that happened at the same time. So there's an association, and you were careful to say association. But it's important, I think, to be careful that we maybe don't oversell. Where is the causation? I mean, it does seem really clear that between retail and institutional, there's real complexity effect. But you do a lot of analysis across a lot of dimensions, and are there times when something is just an inherently difficult bond issue, and it's going to need a lot of disclosure, but it's inherently just risky, and so that complexity is not really causing the complexity of the disclosure isn't really causing the pricing. It's just two things that are coming out of the same, like ice cream shit sales and shark attacks or whatever. Probably one's not causing the other. Although I probably want some ice cream if I was scared by a shark. But so and then if you've got a nice school district, whether it's 100 pages or 200 pages, and whether you get the biographies of all the board members, I don't know if that really is going to affect the pricing very, very much. So, but I think that everybody's got to be really careful about the call option in the muni world, and just taking the comparable maturity treasury. A 30-year muni isn't really a 30-year muni most of the time. It's really much more likely to be a 10-year. And so to compare that against a 30 is, could very possibly distort your results. So again, I really appreciate the paper, and thanks very much.
Thanks, guys. I guess one of the questions that I have is, or one of the observations, I guess, that I have is that remembering that these documents are the bond indenture. It is the security, and the institutional market wants to see all the fine print and all the details, and they actually read through them. And the more disclosure you have, so the idea that, and when you brought up causality, the idea that that complex sentences and complex words are somehow associated with higher yields or higher spread seems to me to be that it's just the reverse. Something that is a lower quality security is going to require more disclosure, more explanation, and it gets complicated in the document itself. And so I would just say, I guess echo Wynn's comments that be careful with causality versus correlation. But Marcus, why don't you take a few minutes to respond?
Yeah, thank you both for those comments. I'll just one thought about that. We do a lot to try to control for the observable things that you can see being different between the different types of bonds, the size of the bonds, the maturity and callability. Ultimately, it's difficult to distinguish the communication of the complexity versus the complexity of the actual bond. And we've been working on more ways to look into why that might be driving the results. I think that's why the clientele results are so interesting, is because we see a lot of the dynamics coming from that retail space versus institution with plausible exogeneity and how we define those clientele effects. One thing I didn't get to show, and you mentioned it might be the reverse in terms of the complexity benefiting. In the secondary market, and there's all the caveats with how much trading is happening, but we see markups are actually smaller when it's an institutional trade for more complex bonds. Now it's higher for retailers, but it's actually smaller for those institutions where you can kind of see a clean cut of they're likely the ones trading here, which is consistent with what you were saying. So, and then Win, awesome comments. We really thank you for all that time. He warned us about him bringing up the call option spread in terms of instead of the yield spread. So we looked at, and it's a very small subsample of non-callable bonds, and things are qualitatively similar there, and you still see that big increase in complexity. So that was reassuring, but I think we do need to do it at a full sample and do it more thoroughly. So sure. Thank you for that. I'm definitely stealing your Willy Wonka reference for my slides next time. And that clarity versus complexity, that paper, that sounds like a good breakthrough for us. So please share that.
Okay, questions, Lori?
Let me bring you a mic.
Oh, sorry.
Oh, thank you. I think that there's a huge difference depending on the bond as to who's reading, if anyone, the disclosure statement. And that's what you were getting at with the retail and institutional. But I think it's relevant who's writing. So in those official statements, you have the names of the law firms, you have the names of the underwriter, you have the names of the underwriters council. I think it's funny because I'm always telling my clientele, public agencies, don't worry about the who, look at the what. But here I'm going to say, look at the who, because people do have styles and approaches. And then I would also think that, and by the way, I love your paper and I love the concept of it. And I would also look at whether it was a competitive or negotiated sale. And that is something that I don't hear that in any of the papers here, but it is relevant to every bit of research because the process for bringing a bond to market in a competitive sale and a negotiated sale is very different. And then I'll just say I've had dozens of expert witness cases in which it appeared to me that I was the only person who read the official statement. And so people are being deposed, right, going back, did you read the official statement? And they're like, yes. And they're like, do you have any correspondence on it? Did you ask any questions? Is there any evidence whatsoever that you read this? And they didn't, but they're testifying that they did. And then when we show them what apparently they weren't aware of, the case kind of ends, right? And then the other thing is you said something about the SEC. And my observation is there's very little prosecution of a failure to disclose, even though they may have increased the cases in terms of how many bonds there are. And yet in a litigation, that disclosure document is absolutely key at almost every single point of a claim, going to what that official statement said. So you're talking about lawyers reacting to litigation or prosecution, and I think you should actually interview, the ones that you're seeing in the high complex and the low complex, some of those counsels that wrote it, and ask them what influences them, because what you might find is you have some proxy factors, in your regression, and if you actually ask them what's motivating, you'll find some interesting things, because I don't find that lessons of litigation actually make it anywhere. And the reason is because so few bonds default. So people will say we're doing this to avoid this kind of problem. And when I'm on the beginning, I say, has that problem ever occurred that you know of? And people, they just don't. They have a point of view and a bias and whatever. So I encourage you to get more into the people and how they're making decisions. And then I will just say, over time, I've seen these things get so complex that nobody reads them. And there's one more thing. I have no idea if you can test this, but you're doing this stuff with language. The lawyer writing and the financial information coming from somebody else can produce not good disclosure or excellent disclosure, depending on that process. So I don't know how you would explore that, but I'll just give you a simple example. Very often what I do in an expert witness case is I take the numbers that are in the official statement and I just extend them further in time, or I do one small change to them and I show that the bonds defaulted exactly as predicted in the official statement if the numbers had been extended. Does that make sense? So it's like a simple thing. Why is this only being shown for 5 years when it could be shown for 10? Right? Why are these 7 factors shown and not totaled? It's things like that that make the difference. So there's a numbers language issue, and I'm not articulating it very well, but if you want to talk to me after, I'll give you some more examples.
Oh, that would be great. Yeah. That was more questions that I can respond to even in that one. So I'll try my best. That was awesome, Lori. I'd love to talk to you more about it. So in terms of who is writing it, I agree that's a very important thing. We did look at competitive versus negotiated issues, and we see that it was primarily strongest in the negotiated. And there's various reasons for that, which is what we need to untie. Is it because retailers can participate, or is it because it's mostly written by the underwriter? But we need to collect that data. We need to collect the number of bond counsel, the number, because these things have all expanded throughout time. And I think once we have that data, we can answer more questions about who is writing it, how important are they within that. But and I agree, we need to do. This is our first step in more interaction with practitioners, but we need to interview some people to get to the bottom of it. But
I think I want to keep moving. We only got a minute left here, but Laurie, thank you so much for those comments. Always appreciated. I just want to keep things on schedule here, so I'm sorry for the audience, but let's thank you, Marcus. Thank you, Wynn.
Okay, our last paper for this session, Financing Infrastructure with Inattentive Investors, the case for U.S. municipal governments. Ehsan Azarmza from the University of Illinois in Chicago, and Financing Infrastructure with Inattentive Investors. You better pay attention.
Hello, everyone. Oh, I need to speak to you. Hello, everyone. It's great to be here, and it's a great pleasure to present my work and get your feedback on it. So I should say that it's my only municipal bond-related paper, so I really need your feedback on this. Okay, so definitely, as everybody knows in this room, municipal governments are responsible for providing infrastructure stuff like schools, hospitals, roads, bridges, and they finance these projects by borrowing in the municipal bond market. So municipal bond market is the primary source of financing for these important projects. And because of that, the functioning of this market, this municipal bond market, is very important for us. So that's the topic of this paper. There are some puzzling observations in the market. On one hand, we see that the bonds are quite safe in terms of their probability of default. So the empirical rate of default has been quite low. So they are safe and they should be very attractive for investors. That's one thing. The other thing is that in the academic literature, we have several evidence suggesting that these governments are facing difficulties in raising their debt. So they have difficulties in getting the financing for investing in these projects. So it's kind of a puzzle for us. So potentially there are several reasons that are contributing to this puzzle. It could be related to taxes. Some papers have shown that. So it could be about regulation to some extent. But here I want to talk about the role of investor composition. So it's something that actually Marcus talked a lot during the previous presentation, that the investor composition in the market is very unique. It's something that you can see in this figure. So more than 40% of the municipal bonds are being held directly by the household sector. This number for corporates and treasuries are 7% and 6% respectively. So in terms of investor composition, things are very different compared to other markets. And the point that I want to make during this presentation, this investor composition matters for the ability to raise financing, and actually it can make it difficult for governments to raise financing, at least in a timely manner. Okay, so households are being known to be a buy and hold investors. They don't necessarily pay attention to the market developments or new bond issues, and because of that, I argue that the borrowing ability of these governments are limited to the capital available to mutual funds and institutional investors. So that's the thing that I test in the data, and also I have a model to kind of illustrate the mechanism, and I do some calibration. Okay, so to illustrate this point, this figure is helpful. So this figure shows the ownership of municipal bonds by the mutual fund sector by quarters after issuance. So what we see is that mutual funds, as the specialized intermediaries in this market, they disproportionately hold newly issued bonds and gradually resell those bonds to the rest of the market. And this transition takes more than 10 years. This figure is very robust. So you can see many versions of this paper in the appendix version, in the appendix section of my paper, which is posted on the web page. It is robust with respect to the choice of a state, credit rating, time to maturity, whatever. And what we learn from this figure is that mutual funds are acting as some form of market maker, that when there is a new issuance, they disproportionately buy the new issue and gradually resell to the rest of the market. And because of this, capital available to these mutual funds is very important for the borrowing ability of these governments. So that's the thing that I test and verify in data, and also I have a model for that. Okay, so as I said, I have a model to make sense of what's going on. So technically, in any market, in any financial market, we can think of things as something in this figure that the ultimate holders of all of these assets, municipal bond or anything else, are households. So the thing that is different in the municipal bond market is the fraction of the direct holding versus indirect holding. And the problem is that the households are quite slow, or maybe they don't have enough time. So Marcus actually had a very good slide for that maybe they don't have the time to actually analyze the assets and the cash flows. And because of that, institutional investors are actually helpful to facilitate the transactions. And the point so the implication of this is that capital available to institutional investors like mutual funds is important. So basically what I test specifically in the empirical section is that the capital flows in and out of mutual funds impact the borrowing ability of these governments. Also, I have results about the cost of borrowing, but I show that the impact is basically larger for the size of the borrowing. And I have a model to illustrate the mechanism. Also, I calibrate the parameters based on my empirical estimates, because eventually what we learn from this study is that how easy it is, quantify it, that how easy it is to raise debt in a timely manner. So I look at the short-term and long-term demand elasticity that is helpful for us to understand how easy it is for governments to raise their debt in a short period of time, like the thing that we needed during a pandemic, that you need to access to liquidity in a short period of time. And it's important how easy it is to do that. Okay. So first I talked about the empirical part. The data I used two main data sources. One is Bloomberg, from which I obtained the historical bond issuance data of 262 county governments. I focus on county governments, not state governments or state level government units, because states are very different in terms of regulation and taxes. So you want to somehow control that, or you want to insulate yourself from those differences. And because of that, I mostly compare counties within a state in my analysis. So that's basically the nature of analysis. And counties are good because they're the largest sub-state government units. I mostly focus on the largest county governments and the ones that are issuing bonds frequently. And the other source is CREST, from which I obtained the historical holding data of mutual funds. And because of that, I can see which mutual funds are important for a certain county government. And some summary statistics. So these county governments issue $82.3 million in every quarter that they have issuance. And they have issuance roughly in 1 out of 4 quarters. Regarding the mutual funds, in my sample, so their market share has almost doubled over the past 10 years, and that's another reason to understand what's the role in the market. And one important thing about the mutual funds is that they have very little cash buffer. So when they receive withdrawal requests, they need to respond by selling some of their assets. And because of that, capital available for them becomes important. So that's the thing that I verify. So they cannot respond to withdrawal requests by just basically using their cash because they don't have any cash or they have little cash. Okay. Another thing is that these mutual funds hold very diversified portfolios. There is no mutual fund that only specializes in county government, so they hold very diverse portfolios in the states at which they are active. And you see that the average exposure to county governments is about 5.9%, and in the 90th percentile is 11.7%. And the maximum exposure to a single county the 90th percentile exposure to a single county government is about 2%, so there is almost no mutual fund that specializes in a single county government. So that's something that becomes important in the identification. Okay. So what do we want to do? So regarding the strategy, okay, so first the hypothesis, as I said, was that we want to understand how these capital flows in and out of mutual funds impact the borrowing ability of these governments. And the problem is basically endogeneity of these flows in order to establish a causality. So flows basically change with the taxes, the economic condition. So the trick here is to basically exploit the heterogeneities across county governments in their exposure to mutual funds. I talk about that and I clarify that in the next slide, but it's a very, very standard strategy in the empirical asset pricing literature. Okay, so in my data, I have a bunch of county governments, bunch of funds, and these funds, some of them are more, some of these county governments are more exposed to some funds, less exposed to the others. For example, Fund 1 is an important fund for County 1, but Fund 2 is less important. So suppose Fund 1 receives a large outflow, it means that it needs to sell some of these assets, especially County 1 gets affected, County 2 gets affected less. And because of that, County 1 faces more problem in raising new capital from Fund 1 or overall. And because of that, we want to see how County 1 responds to this outflow, how this outflow impacts County 1 compared to County 2. So basically, we are going to compare County 1 to County 2. But overall, in the data, definitely all funds receive some sort of inflow or outflow. So what I look at is the aggregate impact on the demand for the bond. So basically, I construct this measure of flow-induced demand by aggregating the impact, and I look at how counties with a high flow-induced demand behave differently compared to counties with a low flow-induced demand. So that's the empirical strategy. And because of this, I'm isolating the impact of taxes, economic conditions. So because I'm just comparing these county governments based on their exposure to mutual funds. Okay. So the assumption here is that the cross-section of the flows is uncorrelated with the government funding need. What does it mean? It means that if I'm investing in Fund 1, I'm not doing that because Fund 1 is a little bit more exposed to County 1 rather than County 2. And that's basically okay because, so as I said, mutual funds hold very diverse portfolios, and because of that, so basically their exposure to county government is very small to basically make to make investors to invest in a certain fund. Okay, so now we get to the result. So what I find is a 1% increase in the flow-induced demand increases the size of issuance in the next quarter by 0.2%, and this result is robust with respect to different basically a specification, different set of controls after controlling for the economic condition or the financial situation of the counties. Even with considering the taxes, I have a whole section about the role of taxes in the results, and this result is quite robust. And also look at the long-term impact. So the long-term impact is a bit smaller. So 1% increase in the flow-induced demand increases the size of issuance in the fourth quarter by 0.1%. So the short-term impact is about 2 times larger than the long-term impact. So short-term impact is quite large and it's something that is important in my calibration. Regarding the cost of issuance, it impacts the cost of issuance, But the thing is that the size is way smaller. So 1% increase in the flowing this demand decreases the cost of borrowing by 0.2 basis points. So the impact is about 100 times less than the impact on the size of borrowing. So what we learn from these observations is that when mutual fund, when county governments receive basically demand from the mutual fund sector, they mostly respond in the quantity dimension rather than the price dimension. So basically, their supply of bonds is quite elastic, and it makes sense. So when they are ready to issue new bonds, so they're mostly adjusting in the quantity dimension rather than the price dimension. Okay. So now I talk about the model, and in the model we have a representative municipal government that sells the bonds, and the bonds are risky. And I matched the product of default with the empirical the empirical default rate. And on the demand side, we have some investors directly investing and some investors indirectly investing in the mini bonds. And if mutual funds are taking the money of the indirect investors and investing in the mini governments, the key element of the model is that these investors are slow in their rebalancing. So they rebalance. So basically their speed of rebalancing is captured by 1 minus lambda. When lambda is higher, it means that they are slower in their rebalancings. And basically, but mutual funds are different, so they are active. So I also estimate the demand for the mutual fund sector. So I basically use the empirical estimates to calibrate this model. What I find is that the elasticity of supply is quite high. So to basically match this observation that most of the response is in the quantity dimension rather than the price dimension. The long-term demand elasticity is also high. So there is no problem in the market in terms of the long-term demand. But most of the problem is in the short-term demand. The short-term demand elasticity is quite low. It means that the market is quite slow in responding to new bond issues. And because of that, the empirical evidence suggests that governments have difficulty in raising debt, expanding their debt quickly, and that's especially important in times of a pandemic or the time that actually they need to access liquidity. And to conclude, so I started this puzzle that governments are behaving as if that they are credit constrained while they are issuing bonds that should be very attractive to investors. So the explanation, so there are several factors that basically contribute to this. So I argue that partly is because of the fact that, because of the investor composition, the fact that the market is dominated by retail investors. And the implication is that capital available to mutual funds and institutional investors is important for the borrowing ability of these governments. And it's something that is consistent with data. And also I develop a model to illustrate the mechanism. And the policy implication is that the mini market is not resilient against shocks. So at a time of pandemic or at a time of crisis, maybe the government need to provide some assistance with access to liquidity because of this. The problem from the investor composition is very difficult for governments to expand their debt quickly. And in fact, in my model and with the calibration, I can provide some rough estimates that how much assistance should be provided based on the amount of capital outflow that the mutual fund sector experiences. Thank you very much.
So the discussant, Kent Haichu from E&Y, the Federal Reserve, U.S. Treasury, and the list goes on and on.
Thanks very much. How do I make this? Okay. It's the hardest part of the presentation. This is my first opportunity to be a discussant, and I think this paper really epitomizes what this conference is all about. I had a 30-year career as a public finance investment banker, and I'm totally intimidated by economists like Hassan and his expert statistics, regression analysis, econometrics, and so forth. So I'm not going to attempt to pierce those issues or try to understand those issues. I'm going to give you, and I've given Hassan, a perspective from what I observed over the course of my career. And that's the approach I'm going to take to this presentation. The summary of the findings, as I read the paper, trying to turn it into English, is that tax-exempt securities are primarily attractive to individual retail investors who are, quote-unquote, inattentive. Therefore, attentive mutual funds are the conduits for retail to initially purchase new issues before redistributing them over time, as Hassan's first chart demonstrates, and in fact it ties in very well with the first paper that I participated in this panel. In periods of reduced retail demand and/or mutual outflows, the cost and availability of capital for infrastructure is impeded. The conclusion to that is that this retail dynamic that we all know about in the municipal market is a primary reason for the poor state of U.S. public infrastructure. And finally, in terms of the policy recommendations, Hassan suggests that the Federal Reserve should intervene during periods of mutual fund outflows to support state and local infrastructure investment. So overall, this is a great paper because it demonstrates what we all know in the municipal bond market and what we practice every day is that our market is heavily dependent on retail investors, whether it's direct or indirect, because of the tax exemption that is available through the tax code. I think my issues really surround the use of inattentive and attentive, which is why I've quoted them, because I think it is kind of a pejorative term that doesn't really appreciate what's going on underneath and why these kinds of behaviors occur. And then lastly, I want to talk about the conclusions that Hassan draws from this dynamic that we all appreciate. So why are retail investors considered inattentive? There's a number of reasons. First of all, when we're talking about selling retail bonds, the sales commission that is available that motivates broker-dealers to sell these in the primary market is very low. So it's $50 if you sell someone $10,000 of bonds. And so we always had a favorite expression that Wynn can appreciate when we have a pricing wire that goes out and it explains each maturity, as Kevin was showing, what the price is, what the yield is, and then over here, I'm sorry, and then over here on the right is the sales commission. And we always used to joke that the retail and broker dealers, they don't read right to left, they read left to right, right? So if they see a sales commission for $5, they're probably not going to call their retail customer. And instead, they're probably going to sell them a bond in the secondary market at a much bigger spread. Or they may sell them another entirely different asset class that has much bigger spreads. Number two, the municipal market, as we know, is really 50 separate markets. Individual retail usually buy retail bonds in their own state. And so the timing and size of retail demand isn't clearly, in most instances, not going to correspond to when an issuer is coming to market. And then the third point is, I think people don't appreciate the mismatch between the availability of capital from retail and the need for capital by issuers. Issuers finance long-term assets, capital improvements, over a 20 to 30-year horizon. Retail investors have no interest, the typical ones, in investing for 20 or 30 years. And so the concentration of retail demand is at the front end of the curve, not at the long end of the curve. And of course, most of our debt is sold as level debt service with ascending principal. So the principal is backloaded and the retail demand is at the front end. And so there's a mismatch between, even though our market's dominated by retail, there's a mismatch between the individual retail investor and what the issuer wants. Let's turn to the mutual fund side, the attentive mutual funds. Well, why do the mutual funds, why are they such big players in the primary market? Well, when you go to market and you need $10 million to build your new school, you can't just say, I'll take $5 million and be done with it. You need to price the entire issue at a clearing price. And so you need institutions to support individual retail so that the entire bond transaction can get done on the same day, same time, and at the same interest rate. The issue about mismatch is solved by mutual funds. Mutual funds effectively create synthetic demand for longer term maturities because they take in retail investments which are available at the NAV at any time to get out, to redeem, and they're able to look for yield and buy at the long end. So essentially, institutional investors and in particular mutual funds are critical to resolving this mismatch between retail and the needs of issuers. If we didn't rely so much on retail, the natural buyers would be pension funds and insurance companies who would otherwise not benefit from tax exemptions, so they are largely absent from our market. But I will say that there are also times when there's less retail demand, when traditionally we have what are called crossover buyers that come in who are not natural tax-exempt buyers, but they see the inefficiency in the muni subsidy, the tax benefit, and they come in and they buy the bonds, and the market is then strengthened, and the value of the tax exemption goes back up, and mutual funds come back in. So that's inattentive investors versus attentive ones. The conclusion that absence of retail demand inhibits state and local infrastructure investment, I think, is largely true, but I would like to distinguish between the cost of capital versus the availability of capital. And generally, because of these market forces, my experience is that issuers don't largely time their issues to when there's a lot of demand, when there's a lot of supply. They generally have a long schedule of governmental approvals and creating very complex disclosure documents that when they're ready to go, they have contracts that have been signed, and for new money issues, they come to market. I think it's more likely that this timing issue is directly affecting refundings more than new money, and I'll talk about that in some data suggestions. So I wonder, and again, not able to comment on Hassan's incredible regression analysis work, if it's actually true, because my experience is that it's not, that retail demand actually impacts the availability of capital. It certainly impacts the cost of capital. What I think the paper doesn't explore is the state and local debt capacity limitations on infrastructure investment. And I think that's the strongest factor, two factors being the affordability, the ability to afford debt service, and the political support necessary to raise revenues, whether they're taxes, fees, fares, utility rates, whatever, that are necessary to support investment in infrastructure capital. Just two examples here in terms of the inflows and outflows of mutual funds. So obviously in March of 2020 through April of 2020, just in like a 6-week period, we had about $45 billion, an unprecedented outflows into out of mutual funds as retail rushed to get out of the market as the pandemic took hold and all the markets were put into a crisis. It's interesting, though, that with the beginning of the Fed tightening policy, we've had 3 times as much outflows as during that period during the pandemic, but outside the municipal market, no one's really aware of that or talking about it because it's occurred over, a 12 to 18 month period. And certainly during March and April, for a whole lot of reasons, we had illiquidity, we had no issuance. But I don't believe that issuance has suffered particularly, other than refundings, during the last year. And then lastly, I've always been an advocate of trying to deal with this retail issue by expanding the market into taxables. Quickly, just suggestions for Hassan's paper. I think he may not be capturing a very important element of demand, which is principal reinvestment in the mutual fund. So as municipalities either pay off their debt, whether through scheduled amortizations or redemptions, they reinvest that into the marketplace. I don't know if that was picked up in the data. The increasing importance of SMAs, several people have mentioned. There was a headline by Bloomberg yesterday that SMAs now account for 25% of the municipal market demand. Again, I'm not sure that was picked up. I've already mentioned, I think it would be very interesting to do the analysis separating out new money deals from refundings. And I would also be interested in seeing the same analysis if we focused on large repeat issuers, regardless of whether they're a county, a state, or a revenue bond, because I think their behavior may be different than what Hassan found with 262 counties. Lastly, I have to comment on the policy recommendations. Being at the Fed when I learned a lot about the Federal Reserve's authority, its legal authority, and Section 13.3 dictates when the Fed can intervene in unusual and exigent circumstances. It takes a vote of 5 of the 7 Reserve Board members, the governors, plus the approval of the Treasury Secretary in order to intervene. The statute says there has to be an inability to secure adequate credit accommodations. It's reserved for providing liquidity to the financial system. It's effectively a backup, not a first lender. And there has to be, the interest rate has to be set at a penalty to encourage repayment of the loan as quickly as possible once normal market conditions are restored. A lot of people didn't like the interest rates for the municipal liquidity facility, but that's where it comes from. And I question, having been through this once, how likely it would be for the Fed to intervene only in the municipal market as opposed to all markets. I think the reason the Fed intervened in the COVID for the first time in its 100-year history in the municipal market was because all the markets were in disarray, including the municipal market. Even if the statute provided the opportunity for the federal government to intervene, I think there are serious policy questions around moral hazard, as we talked about on some of the panels yesterday. And then finally, my favorite sort of policy issue that, or the issue that policymakers, I think, confuse all the time is the difference between funding and financing. I think we have plenty of capital in this country, but we don't have, we have plenty of financing and capital in this country, but we don't have funding capacity, meaning the revenues to support investment in infrastructure. So with that, I appreciate Hassan's paper and the opportunity to discuss it with you today.
David, we're running right up against 11:15. Should we pass on Q&A? Okay, good. So Hassan, why don't you briefly respond, and if we have a minute for a question, we'll take it there.
Sure. So, this one. Okay, perfect. Okay. So first of all, thank you very much for the comments. So I really couldn't ask for better because, as I said, so it's my first municipal bond market related project. So, and I learned a lot from your comments, and definitely I took them, I incorporate them in the next version. And I'm also very glad that you agree with the main point that so there is this problem with the investor composition. We should take it more seriously, and it could affect the access to capital. So and also I agree with your suggestion that we should basically expand the taxable portion. I really agree with that, and that helps with the financing. And regarding a few points, so yeah, I need to look at the new money versus the refinancing. So that's important thing, because eventually what we want to understand is that whether governments have difficulty in funding new projects rather than just refinancing the older debt. And regarding the timing, so there is something that I couldn't show during the presentation, that this demand from the mutual fund sector cannot predict the timing of the issuance. It can only, so basically, once the government enters the market, so condition on issuance and being ready to issue, that's the thing that demand actually gets affected by the demand. So condition on issuance, demand impacts the size of issuance. So that's basically what I find, which is kind of consistent with the fact that it's very difficult to, and there's a long process of getting to the market. And yeah, so you raised a lot of several points that I need to basically take into account in my empirical analysis.
I think we have time for a question or two. Yes, Mark.
Thanks. The underlying problem seems to be the tax exemption, because that creates a much more narrow market and a much more illiquid and maybe reactive market. So I'm wondering if, building on something in one of Ken's slide, how do you feel about the following solution, which is that we permanently replace the tax exemption on municipal bonds with a subsidy to the issuer. So basically make the Build America bond permanent and use that as a replacement for what we currently have.
So I see my friend smiling in the back on that question. I think that would be a very difficult politically, and I think from a policy point of view, there's problems with it, because the history of the BABS program is that Congress began to cut back the subsidy, and that has left an incredibly sour taste on the issuer side, and I think it creates policy uncertainty going forward. But I am a big advocate of BABS as a market regulator, so that if there was the right subsidy level and that was always available in the marketplace, first of all, you could develop a consistent demand from the taxable sector. The taxable sector never invested the time and resources necessary to be true muni investors, because BABS only lasted a year and a half. But if it was permanent, you could build that capacity. And then when the tax exemption got too cheap, and this was going on the yield curve when we sold BABS. We only sold BABS on the long end. We used traditional tax exempts on the short end, and we created a blended structure that was the most efficient. And having that BABS as a market regulator together with tax exemption would bring in new investors while keeping the benefits of the retail.
Mark, you had a question? And I think that's it. We'll wrap it up. Go ahead, Mark.
It's just a comment. I am so glad that Kent mentioned the politics. You know, issuing bonds generally requires voter approval and frequently requires a supermajority. That is a major constraint.
Hassan, Kent, thank you very much.
Thanks, Mayor.
Great. Thank you all. We're going to take a break. We'll be back here in 13 minutes at 10:30 for our next panel.